This is Mike Reed with cEntellect, and welcome to this week's Crude Highlights. The announcements coming out of OPEC have been fast and furious over the past 2 weeks. We really put the announcements into 3 buckets. The first bucket is an OPEC announcement. The second bucket is an OPEC Plus, the extended family. And the third bucket is it really representing the Saudi Arabia-Russian pact or alliance. We believe that the only one you should really follow today are the announcements coming out of the third bucket, Saudi Arabia-Russia pact, what their announcement is and whether or not they're going to follow through with it. And the reason for that, if we take you back to the first bucket on OPEC, we believe that non-Saudi Arabia OPEC compliance with cuts will only come in at 13%. Said another way, non-Saudi Arabia will only cut 13% of what they commit to. The second bucket's the same. On the OPEC extended family, only commit to about 13% of what they say they will. So the burden of the cuts really falls on Saudi Arabia and Russia. And so we are largely ignoring OPEC announcements, largely ignoring OPEC Plus, and really focused on Saudi Arabia and Russia announcements, behavior, and follow-through. We have been bearish crude oil since May of this year. That view has returned year-to-date 22% unlevered. We've had 2 short periods where we stopped ourselves out. We're actually in the third period now of a more elongated stop. We went flat about 4 weeks ago. Our current strategy from a position standpoint is to go ahead and re-implement a short position, but we're going to wait until it retraces to $55, $56 a barrel. We're hoping that happens more sooner than later. Again, we don't think that the cuts are going to follow through beyond the magnitude of what the market believes. So we'll re-implement if we retouch 55, 56. Otherwise, we're going to remain short. We really remain short on 5 drivers I'd like to walk you through. And by short, we have a view that crude will settle for the July contract between $44 and $49 a barrel, between $4 and $10 a barrel less than it currently is today, trading at about $53. Let me walk you through the 5 things kind of one at a time. The first is we see currency up 0.5% week on week, and it's actually up 9% over the last 34 weeks. Currency is a huge drive of crude price. I would argue that it drives 50% of the crude price. It's negatively correlated. When crude goes up, or when currency goes up, crude price falls on average about $2.75 a barrel, and vice versa. What we saw throughout last year, 2017, is a divergence of the relationship between crude and currency. What we've seen through the first half of this year is a continued divergence, or at least flatlining, and what we've seen as of late is a tremendous convergence back to its normal relationship. So we see that convergence continuing for the balance of this year, as well as the first half of 2019. The second reason is stocks draw last week are 1.2 million barrels. That was week 2 of a 7-week normalized draw season. So we'll see how the next 5 weeks play out. But at only 1.2 million barrels compared to a 5-year average of 4.2 million barrels, it has some very, very bearish implications. The third reason is U.S. imports were up 1.7 million barrels per week, week on week. Fourth reason is U.S. exports were down 6.5 million barrels per week, week on week. And the fifth and last is refinery utilization is off slightly, down about 0.5 million barrels week on week. So that kind of sums the 5 reasons to give us our bearish view, with currency being a key driver. And we're very, very leery or skeptical of OPEC Plus announcements. For this and much more of our crude views, including some of the bullish drivers that we see in crude, please visit us at cEntellect.com.